When a company generates more cash than it can profitably reinvest into its operations, management must decide how to handle the surplus. A company's payout policy dictates the specific mechanisms used to distribute this excess cash to shareholders, directly determining the form in which investors receive their return. This distribution process only applies to genuine cash payments. Companies also engage in transactions like stock dividends and stock splits, which are frequently confused with actual payouts. Stock dividends and stock splits distribute zero cash. They merely carve the existing equity into smaller, more numerous pieces. Because the underlying assets remain entirely unchanged, these maneuvers do not create any actual wealth for the shareholder. To understand how cash distributions affect valuation, we have to start with the baseline theory of modern corporate finance, the Modigliani-Miller payout irrelevance proposition. The core argument of this proposition states that in a perfectly frictionless market, a company's dividend policy is entirely irrelevant. Assuming no taxes, no transaction costs, and perfect information, the total wealth of a shareholder is determined strictly by the earning power of the company's assets, not the way the cash is handed out. But real-world markets do not operate in a vacuum. They are defined by frictions, specifically taxes, agency conflicts, and severe information asymmetry. These frictions transform payout policy from a theoretical math equation into a strategic tool for managing value. Evaluating a company's true equity value requires a dual analysis of the volume of cash generated and the specific friction-laden pathways management chooses to return it. The foundation of the irrelevance theory was laid by Franco Modigliani. Working alongside Merton Miller, the two established the mathematical baseline for how investors extract value from corporate assets. Their central concept is the homemade dividend. If a company chooses not to pay a cash dividend, an investor operating in a perfect market can simply sell off a fraction of their shares. By doing this, the shareholder synthetically creates their own preferred cash flow stream without needing management to issue a formal payout. The first major friction that breaks this perfect model is investor preference. The bird-in-hand theory directly challenges the irrelevance proposition by focusing on certainty. This theory contends that investors assign a higher premium to $1 of cash dividends received today than they do to the uncertain promise of capital gains in the future. The risk profile of cash in hand is distinctly lower than cash retained by the corporation. The second major friction is tax asymmetry. Governments rarely treat all forms of return equally. This maps three distinct tax systems. Under double taxation, profits are taxed at the corporate level, then again as dividends. Tax imputation removes this penalty, providing a direct shareholder tax credit. Finally, split rate taxes profits at varying rates based on whether earnings are retained or paid. If a country taxes dividends at a significantly higher rate than capital gains, taxable investors will demand that management aggressively reinvest earnings or repurchase shares to shield returns. The macroeconomic tax regime dictates the optimal payout strategy. The third major friction is information asymmetry. Public investors never have the complete operational picture. Because corporate managers have significantly better visibility into future earnings than external shareholders, regular cash dividends operate as a highly scrutinized signaling mechanism. A regular dividend is an explicit, recurring commitment. When management initiates or actively increases a regular dividend, they are signaling strict confidence in long-term cash flow. Conversely, omitting or cutting a dividend sends an immediate negative signal, usually triggering a severe drop in the stock price as markets price in an operational crisis. To avoid the severe market penalty of a dividend cut, corporate managers rely on a stable dividend policy. This approach deliberately separates the growth rate of the dividend from the immediate cyclical volatility of the company's earnings. This process uses a gradual adjustment formula. Management determines expected dividends by adding a calculated increase to last year's payout. This increase relies on a long-term target ratio. Finally, an adjustment factor mathematically forces dividends to increase at a lower rate than extreme cyclical earning spikes. Compare this to a constant dividend payout ratio policy, where management blindly applies a target percentage to current, real-time earnings. That approach subjects shareholders to highly volatile dividend payments that mirror every swing in the business cycle. Regular cash dividends function as inflexible communication tools. They help reduce agency conflicts by forcing management to part with cash, while simultaneously signaling a strict measure of investment quality to the market. Because regular dividends carry such heavy signaling constraints, management frequently turns to the primary alternative for cash distribution: share repurchases. Share buybacks are typically executed in one of three ways: open market purchases, fixed price tender offers, or a Dutch auction pricing range. Companies rarely negotiate directly with major shareholders to buy back specific blocks of stock, because paying a premium to a single entity typically destroys value for the remaining stockholders. This ledger visualizes a strict rule: a share repurchase is mathematically equivalent to a cash dividend in its effect on total shareholder wealth. The cash leaves either way, but in a repurchase, the outstanding share count shrinks. Shareholders who don't sell effectively increase their proportional ownership. Management utilizes buybacks precisely because they provide flexibility. They allow a company to distribute extraordinary surges in earnings without establishing the permanent expectation that a massive cash distribution will be maintained indefinitely. A share repurchase transfers the exact same amount of corporate wealth to the market as a dividend, completely bypassing the long-term signaling handcuffs of a regular quarterly payout. Because repurchases actively reduce the outstanding share count, they inherently alter the per-share valuation metrics used by analysts. This flowchart tracks how buybacks alter earnings per share. Using excess cash keeps net income stable while share count drops, increasing EPS. But a debt-funded buyback incurs interest. It only increases EPS if the earnings yield is strictly greater than the after-tax borrowing rate. Otherwise, EPS declines. This seesaw models the mechanical relationship on book value per share. Repurchasing shares at a premium above current book value dilutes the equity, decreasing the remaining book value. Conversely, buying at a discount mathematically increases the book value for every single remaining share. A buyback program does not automatically mean management thinks the stock is undervalued. It can be used to engineer higher EPS figures while actively diluting the fundamental book value of the underlying equity. For the financial analyst, a dividend or a buyback program is merely the starting point. The objective is to determine whether the company's earnings and free cash flow are sufficient to sustain the payout policy over the long term. Degrading dividend coverage ratios and abnormally high dividend yields are primary warning signs. They indicate the market has already priced in the mathematical probability of a dividend cut. If a company tries maintaining signaling power by funding dividends or buybacks through continuous borrowing, it risks incurring severe flotation costs on new debt issues and ultimately violating legal debt covenants. An analyst must filter out the signaling noise. The past dividend record only holds value when mapped directly against the actual cash flow generated by operations. While taxes and signaling determine the ultimate efficiency of the return, the foundation of shareholder wealth remains the operational machinery generating the cash. Payout policy does not create that value, but it is the mechanism that determines how much of it safely reaches the investor.